One of the main reasons for the RBI's higher net income in FY 2023 was the increase in foreign exchange gains. Foreign exchange gains are the profits made by the central bank from buying and selling foreign currencies. The RBI holds foreign currencies as part of its reserves to manage the exchange rate and intervene in the market when needed. In FY 2023, the RBI saw a gain of 1.03 trillion rupees from foreign exchange transactions, according to its annual report. This was a significant jump from the previous year, when the RBI had a gain of only 295 billion rupees from foreign exchange transactions. How did the RBI make such a huge profit from foreign exchange transactions? There are two main factors that contributed to this. The first factor was the depreciation of the rupee against the US dollar and other major currencies in FY. The rupee fell by about 6% against the US dollar in FY 2023. From 73.11 rupees per dollar at the end of March 2022 to 77.45 rupees per dollar at the end of March. This meant that the RBI could sell its foreign currency holdings at a higher price in rupees and book a profit. The second factor was the change in the accounting method adopted by the RBI in FY. The RBI adopted a new economic capital framework, which allows it to benchmark sales of foreign exchange to its historical average cost of acquiring those reserves, instead of using the current market price. This means that the RBI can ignore any fluctuations in the market value of its foreign currency holdings and only record gains or losses when it actually sells them. The new accounting method also allows the RBI to transfer more funds to its contingency risk buffer, which is a reserve fund to deal with any unforeseen shocks or losses. The RBI transferred 1.3 trillion rupees to its contingency risk buffer in FY 2023, raising its size to 6% of its balance sheet from 5.5% previously. The contingency risk buffer is part of the RBI's economic capital, which is the amount of capital that the RBI needs to maintain its credibility and operational independence. The higher foreign exchange gains and the higher contingency risk buffer helped the RBI increase its net income to 2.35 trillion rupees in FY 2023, up from 1.6 trillion rupees in FY 2022. The net income is the difference between the income and expenditure of the RBI. The income mainly comes from interest earned on domestic and foreign securities, while the expenditure mainly consists of interest paid on liquidity operations, printing of currency notes, employee costs and other administrative expenses. The higher net income also enabled the RBI to transfer a higher surplus or dividend to the government for FY. The RBI transferred a surplus of 874 billion rupees to the government for FY 2023, up from 303 billion rupees for FY 2022. The surplus transfer is based on an agreement between the RBI and the government on how much of the RBI's profits should be retained by the central bank and how much should be shared with the government. The higher surplus transfer from the RBI helped the government reduce its fiscal deficit and fund its spending programs amid the COVID-19 pandemic. The fiscal deficit is the difference between the government's revenue and expenditure. The government had budgeted a fiscal deficit of 6.8% of GDP for FY 2023, but it managed to bring it down to 6.5% of GDP with the help of the higher surplus transfer from the RBI. Thus, we can see that the RBI's foreign exchange income played a crucial role in boosting its net income and dividend in FY 2023, as well as supporting the government's fiscal position. One of the main reasons why RBI's net income rose to 2.35 lakh crore in FY 2023 was the sharp increase in its foreign exchange income. According to its annual report, RBI saw a gain of 1.03 lakh crore from foreign exchange transactions, which was more than double the amount it earned in the previous year. This gain was mainly due to the large gross dollar sales that RBI made in FY 2023 to intervene in the foreign exchange market and stabilize the rupee. Based on RBI intervention data, gross dollar sales amounted to $212.6 billion in FY 2023 compared to $96.7 billion in FY. The higher foreign exchange income also allowed RBI to increase the size of its contingency fund, which is a buffer to deal with unforeseen risks and shocks. The contingency fund rose from 2.32 rupees lakh crore in FY 2022 to 3.63 rupees lakh crore in FY 2023, which is about 6% of RBI's balance sheet. This is within the range of 5.5% to 6.5% recommended by the Economic Capital Framework, which was adopted by RBI in FY. The increase in the contingency fund also enabled RBI to transfer a higher dividend to the government. For FY, the dividend amount was 87,416 rupees crore, which was 188% higher than the previous year's dividend of 30,307 rupees crore. This was also more than the budgeted amount of 48,000 rupees crore for banking sector. The higher dividend will help the government meet its fiscal deficit target and provide relief to its strained finances amid the pandemic.